All right, we're doing learning objective 13.5 and 13.6. So the first one here is preparing a corporate income statement and including earnings per share. This might be the first time we've introduced earnings per share. So basically, earnings per share is just taking this net income and dividing it by the number of common shares of stock. Okay, so the first part of this is the continuing operations, and then notice they have some other income. So everything's probably similar to you up to this point. Now it's looking a little different because when we were a sole proprietorship or a partnership, we didn't really have an income tax expense. But remember, now we're in a corporation, so we do have income tax expense. So we end up with this income from continuing operations. It's very important for us to kind of spread this income statement out so that you kind of know, hey, this is operating. This is what we think they're going to repeat almost every year. If not repeat it, and maybe more. That's more consistent. In this one, they had some discontinued operations. We pulled that out. It's a special item. Yes, it does affect net income, but at least we can see what the continuing operations are. We have these subtotals as the income statement gets a little bit more elaborate. And then you can see we had earnings per share on that income from continuing operations. And then we had it for the discontinued operations. You can see that decreased the, actually, it increased the earnings per share because discontinued operation was adding to our income. Okay. But, if we were an investor, we know this is probably not going to happen again. So we might be looking more at that number, the continuing operations earnings per share. Okay. I think I kind of just said everything that's in that PowerPoint. Earnings per share, I mentioned, is just the net income divided by the number of shares outstanding for common stock. That calculation can get a lot more complicated the further up in accounting you get because you might not have had the exact same number of common stock shares outstanding all year. So there would be a weighted calculation on that. Okay. Well, they do say that weighted average number of common shares outstanding. And now we're going to look at the equity section on the balance sheet. Okay. We have a statement of retained earnings. This gives us what all increased and decreased retained earnings. Remember, I drew this T account out for you in the last video. And I said we hope we have a beginning balance on that credit side. We would add net income. If we had a net loss, that would be on the debit side, and dividends are on the debit side of retained earnings. We hope that we have a credit balance as an ending, but like I said, it could bump over here because we may have had a lot of net losses, paid too many dividends, and then we end up with a debit balance. That would be a deficit in retained earnings. Okay, so this statement right here is everything that I just put in that T account. So don't get confused thinking it's something else. The beginning balance plus net income minus dividends gives us the ending retained balance. Okay. We could have appropriations for retained earnings. We could have some of that set aside. We may have gotten a bank loan, and the bank said, I want you to appropriate $1 million of your retained earnings. They just want it to be restricted to where you can't pay that out in dividends. So that would be like a loan covenant. That can be formalized as a journal entry, but it doesn't necessarily have to be. It could just be in the notes to the financial statements. Okay. Any prior period adjustments that will go to retained earnings. That will be something they fix through the retained earnings account. Sometimes that happens. Okay. So here they have a prior period adjustment. This is Mountain Home Inc. recorded 30,000 of salaries expense in 2025, the correct amount of salaries expense was 10,000. I'm sorry, 40,000. 10,000 more. So in 2026, Mountain Home paid the extra 10,000 in salaries owed for the prior year. So you can see we had retained earnings started at 140. We're going to bring it down by 10,000 because that was an expense that didn't get put on the income statement in the prior period. Okay. So it will adjust the beginning balance to retained earnings, and then we move on with our net income and dividends declared. Okay. Statement of stockholders' equity. This gives us a nice breakdown of everything that has affected the stockholders' equity section. Okay, so you can kind of see here common stock had 20,000 shares. That was the beginning. It was just that didn't change. It was 20,000. And then paid in capital in excess of par, that stayed the same. But here you can see that change in retained earnings. That prior period adjustment is right there. And they have the net income, and then they have the dividends, and then here is our total. But this gives us a nice summary of everything that happened during the period. And that is all for chapter 13.